All right, yield nerds. There was a couple of week gap here because I wanted to make sure we truly understood how the debt ceiling discussion and the issuance of new bonds after that was shaping out. And thankfully, we're not a 24-hour news channel and we're not going to look to fill up time with garbage just so it is out there. Having said all of that, we did make some big adjustments. We piled on a lot of cash leading into June, and we had a plan of participating in treasury auctions. And so I wanted to do a recheck a few weeks later to see if that is still the sound plan or there are adjustments to be made and so on. Welcome to new subscribers. You will see that the show has a playlist and you can look at the playlist right here, and you are welcome to navigate in chronological order. We do have something new this time. We have a new website, Yieldnerdcom, and I'll introduce you to the person who helped monumentally in creating that later on as we go through this. But if you go to Yieldnerd.com, please only do it on your computer. The platform is in beta and it is not mobile friendly, but on the website you should see plenty of value. All right. My usual disclaimers: this is not investment advice, it is education. Decisions are made by you, not me. I am not a wealth management advisor, and I do not have an agenda other than sharing my knowledge. All right. I thought I would structure between now and October 1st as a kind of sort of 100-day plan, if you will, and there is a reason for picking October 1st, and we'll talk about it. There are some early tremors from another area that we're going to be following, and create a 60-day plan and a 100-day plan and see where it goes. We played the game of odds a couple of episodes ago, and I thought, the odds of a good solution was only 20%. And obviously nobody expected that our country would head to a default. I did think that both parties will come up with some kind of a kick the can to July 15th, and that would be the majority solution. And the odds of actually having a minor default was even higher at one point. However, we were all told that bipartisan solutions came about for a 2-year solution, and we did not kick the can. Hint, hint, not entirely true. But we were told we did not kick the can. We created a 2-year solution. How wonderful the parties came together. And what that meant is that we need to increase the country's bank balance or credit limit, so to speak, from 30 billion to $1 trillion. And so a lot of treasuries are coming on the market, and there are other tremors coming on as well. Remember how I told you that, I thought there would be a kick the can approach, but in reality, we created a 2-year solution, kumbaya, problem solved? Not entirely. The very fact that there is a debt deal is going to create, unfortunately for us, a different kind of capitalism at work. And let me explain what I mean by that. COVID destroyed demand. We all know that. Nobody went out to eat. Nobody went to the movies. No hotels. And once COVID died, all kinds of crazy demand started. People wanted to go on vacations again, and they wanted to go to, hotels, and they wanted to go eat out. And prices went through the roof. And then we rationalize inflation by saying, well, that was post-COVID, and now we should see prices come down. They did not come down, so we created another reason. We said, oh, it's China, it's supply chain, and that's the reason why prices are going up, and boats are backed up in this harbor and that harbor, and we kept prices high. And then we said, well, we've resolved the supply chain issues, and inflation is coming down a little bit, but not completely back to 2%. And part of that reason is because disinflation, as it is called, is happening, but a good chunk of inflation is still sticky. And somewhere, somehow, demand needs to be destroyed, as bad as it sounds. And if we don't do that, one vehicle to do that is by increasing interest rates. Another vehicle is something unforeseen like a COVID. If we don't do that, inflation is likely to be sticky. And this sounds like a terrible thing. The powers to be are trying to grab as much profits as possible at the expense of the common middle income family. And as terrible as it is, my snarky remark of the week is, if this kind of capitalism sounds terrible to you, they're looking for people in Russia. Go try that. All sarcasm aside, this is capitalism at work. Those industries, those sectors that can hold the margin are going to try and do that. If you look at what's happening in Italy, this is yesterday or a couple of days before, their prices for pasta are up astronomically to the point where the local populations are approaching the government to see if they can somehow put some kind of a pricing curb on pasta, because it is creating huge stresses for the middle income families in Italy. Second thing that is happening, the government is going to restrict price increases, because in certain things that you cannot live without, in Italy that's pasta, in the United States it could be something else, prices are not coming down despite any and all efforts being taken. Now, what does it mean for the United States for the next 60 days? My humble opinion, and you can go Google, you can look at these trends, you can see where prices of certain things that are buried multiple layers down, where those prices are, and how does it compare to pre-COVID? Are they only 3% or 4% up, or are they up much more than that? What you are going to find is in the subtle things that are in the lower levels of a supply chain of your daily life, such as eggs, gasoline. You and I may celebrate gasoline being around $4 a gallon. What was it pre-COVID? It was 3 something. The difference between $3 and $4 is 33%. So if you truly want to say, has inflation gone away? No chance. In essential items, what about travel? Have you traveled lately? Have you seen the price of a rental car? And so we all sit here and say that inflation is decreasing. All that it means is the rate of increase of prices is decreasing. The absolute price itself is not decreasing except in a couple of sectors. So the moral of the story is, we all see these equities go up and we say, oh my God, this must be the beginning of the next bull run. And none of that, in my humble opinion, is true. Select sectors will have a phenomenal earnings season because you can't live without them. You can't live without eating soy or corn or any of those. You can't live without your essential grains, water, utilities in those prices, gasoline, eggs. Those prices are going to be sticky. And in those same scenarios, those sectors may have value investments and they will experience greater profit. And that is up to you. This is my opinion. The next earnings season may be good for them. However, my humble opinion is, even though the market is sitting here celebrating that, oh, we had a dead deal and therefore, the Dow is up 2-3%, the S&P is up 6%. I won't even talk about the NASDAQ because anything with the AI is up an insane percentage, and they all somehow portend to predict one thing. This is an actual curve of how the Dow performed over decades. And the inversion right here, meaning the low point of the Dow, was 6 months before the last interest rate hike. And that is what the market is trying to predict. The market is trying to say, is now the moment where interest rates are no longer going to increase and they are going to decrease, and therefore companies will find it easier to obtain credit, increase their profits, and there will be this amazing bull run where equities are the place to be. I am not smart enough to know that answer. Left to me, I wouldn't pretend to know exactly when the last interest rate hike is. For all that you know, we may be here. We may be at the precipice of a tip. And there are many, many articles that talk about inflation is not yet done, and therefore we may have a crash. I don't know the answer, but left to me, I don't need a 228% improvement in my portfolio value. I'm perfectly fine sitting out the first 30% and waiting and being patient, making sure that there is enough confirmation that the economy has recovered. But that again is me. Having said all of that, if you went back and looked at what caused this precipitous drop right around the 88 area, it was a credit crunch. Oh, by the way, we have a liquidity crunch that is happening right now. One more thing, there was a very heavy inflation burden on the economy, hint, hint, happening now as well. So I can't tell whether we are here or there, and I certainly am not an impulsive investor to pretend to know the answer, so I would react to it differently. And I told you earlier that there is something in October that may happen as well. Let's talk about that. You know how we are all proud and patting each other's back that the country came up with the solution for the next 2 years? Well, not the case. There is the far-right hardline Republicans, about 12 of them. They recently met with Speaker McCarthy and they said, hey, you know that debt deal, that 2-year solution you came up with? I need you to tell us in writing that we're not going to really do that. So what we are going to do is we are going to look for additional spending cuts, taking us back 2 years, and then also take another 100 billion. I do not preach politics. I don't care whether, this is the right thing to do or wrong thing to do. All that I can tell you is if the two parties cannot compromise on this, and you would hope that they would compromise the same way they were able to compromise in the first salvo of the debt ceiling bill, if the two parties cannot compromise on this new bill on the new compromise, then we are going to see a government shutdown on October 1st. Let's hope it doesn't happen. Treasuries will be safe because we do have the ability to issue new treasuries, but there will start to be government spending cuts that happen on October 1st. Because we cannot spend without it. We can borrow with it. We can borrow with the debt ceiling, but we cannot spend. It's kind of a very oddball situation, but that is what we are heading into. Having said that, what are the best next steps? To sit here and think that a bill was passed and for the next 2 years we have smooth sailing is a fallacy. The equity market certainly seems to think that. There may be specific value investment plays in select sectors that is for you to figure out. Until inflation is tamed, and Chairman Powell has made it very clear that they are going to keep going on with higher interest rates. They may leave it there for longer, increase it even more. They need the inflation number to come down. So maybe the real thing to do is look at what we call the yield Super Bowl. What is the best fixed income investment across various instruments as of now? Speaking of the yield Super Bowl, I need to give a little shout out to Vrain Ahuja. He reached out to me, or I reached out to him actually, and he has been very kind to help with launching Yieldnerdcom. It is a beta site, but every day is Superbowl Sunday at Yieldnerdcom. You can go there and you can see the same charts. You can see without any tax adjustment, and this is what the market shows you. For example, the market may show you today that there are corporates at rates slightly north of 5%, and you may naively think, ooh, we should buy corporates. As you know and I know, corporates, the interest income and the discount are both taxed at ordinary income. And then there are treasuries, close second on a raw basis, and if you instead adjusted these on a pre-tax basis, meaning you added the state tax to the treasuries, and you kept the corporates as is, you will see that treasuries are better than corporates, and this is the basis of what we call yield Super Bowl. And you can then, and this is where you will start the journey, you can then look at your durations. In an increasing interest rate environment, you would be foolish to buy things on the long duration curve, but again, you do you. If you stayed in the shorter duration, you will see that US Treasuries win hands down, and no other fixed income asset class comes even close. As you get longer than a year or more, agency bonds have a good shot at it, and please remember there are only 2 agency bonds that are state tax free. And if you had forgotten those lessons, Yieldnerd.com has a refresher on all of them. You can go through every single fixed income asset class. You can see what the pros are, you can see what the cons are, what are the tax implications, and you can quickly refresh yourself by looking at relevant Yield Nerd videos. You can also plug in your own effective tax rate for the federal government, your state tax rate, and you can generate your pre-tax yield live and see it happen. That is Yieldnerd.com. My instinct, and this is me, is to keep at short-term treasuries and maybe a couple here and there longer-term agency bonds, very small measured bites on value equities in essential sectors. And I'm just going to sit and wait until October-ish to see if there is a crash. And if there is, I'll enter in a large way into the equity market. Otherwise, I'm fine sitting on the fixed income side. You do you. Questions, comments, feel free to email me. Rain, thank you for all your help. Have a wonderful Father's Day, everyone.